Welcome, everybody. I'm Steve Novakovich, Managing Director of Educational Programs at Kai Association. And I am delighted to be joined today by Mark Estante, Vice President of Alternative Investments at LPL Financial. Mark, thank you so much for joining us.
Thank you for having me.
So it's such a really important topic that we're going to spend some time on today. That is of portfolio implementation for in the private wealth space in particular. A lot of advisors now start to have a more of an understanding of the world of alts and how the different strategies work. But really the next question then is, how do you appropriately bring these into portfolios? And what is the process there? How do you think about sizing, diligence, all that good stuff? So I'm really grateful to take the time with you today to kind of talk about some of those more important and detailed questions.
Yeah, happy to have that conversation.
Yeah. So maybe we can start at the beginning. I know that we can't talk specifics. Every client is different. But when you sit down and start thinking about that conversation with the client of let's bring alts into the portfolio, how do you just start thinking about the sizing and the evaluation that you do from one client to the next of whether they should have 5%, 10%, 20%, whatever that number is? How do you
Yeah.
make that evaluation consideration from one client to the next?
Yeah, I think most advisors are used to, establishing a risk appetite and maybe a risk budget, and that's usually based off of volatility or drawdown. For alternatives, I think the next step is to go into what are your illiquidity tolerances and what your illiquidity budget is, and that will help you kind of step down from that and see where you want to go. But I think most advisors, when they're allocating to alternatives for their clients, are looking for one or two things, either enhanced returns or diversification. And so how much they're looking to enhance the returns will help you determine what you're allocating to, or kind of if you're trying to diversify, how much of things outside of the public markets do you want to put in your portfolio to get to kind of a target risk level.
And when you think about from a diversifying standpoint, do you kind of have different buckets that you put different strategies into, or do you sort of just see alts generally as a diversifying strategy? Because sort of a similar question that we get is, okay, great, I've made a decision, I want X% in alts, but then how do I think about that
Yeah.
composition of the alternatives?
Yeah, I think I do kind of think about things in three buckets, and just think about what the client goals are. Typically, it ranges from appreciation to income, and then there's also total return in between. So things like private equity, I would try to put in that growth bucket, and it would probably be sourced from your public equities. And then for income-oriented investors, something like private credit, that would come from fixed income, and that would be there. But there's other things that are kind of in between that can maybe have tax advantages or that provide both income and potential appreciation. Things like real estate and infrastructure on the equity side can kind of go in between, and they should be able to provide diversification if they're truly less correlated to those markets. And then, I think there's also hedge funds, and that's really more of a wrapper or a lack of rules. I would tend to put those in a diversification a bucket. But if it's, long short equity only, probably more along the equity line.
You talked a little bit about illiquidity, and again, every client is different, and also alternatives are not all equally illiquid.
Yeah.
So I'm curious how you kind of think about that, and where maybe thresholds could come into play in terms of how much illiquidity is acceptable versus not, and then we can maybe later on dive in a little bit to the illiquidity of alternatives in more detail.
Yeah. So I think that when you think about a liquidity, the more liquidity would be for clients that are younger, have longer time horizons. And also, you want to make sure that what you're investing in needs that time. So, some assets, like in hedge funds, those are a lot of times liquid underlying. So, it's more of a kind of a product level illiquidity rather than the underlying assets. So, I think that, when advisors are looking for their clients, do they have liquidity needs on the time horizon? And I would just say that for alternatives, whether the illiquidity comes from the assets or the access point, you want to do your liquidity planning with that in mind. These are not going to be tactical trades. These are going to be long-term holdings. Usually I say at least 5 to 7 years, even if there's interim liquidity offered by some of these perpetual vehicles, or what they're sometimes called evergreen vehicles, that we've seen come to the market more recently.
Well, let's use that as a jumping off point, because I think that's a really important comment that you just made, is that when you think about illiquidity, there's the assets
Right.
themselves, and then there's the vehicles. And I think what we're seeing is a proliferation in the market of vehicles that can offer more liquidity than maybe traditionally was the case. Private equity is a great example
Right.
where historically the common vehicle is a drawdown vehicle that could take 10, 12, 13, 15 years to have all the liquidity come back. And now you mentioned sort of interval funds or evergreen funds. How do you think about that landscape? You already mentioned that you may have a vehicle that's evergreen, but the underlying assets still may require 5 or 7 years. So what kind of thoughts do you have around those different vehicles, the appropriateness, that how to use them, how to think about the liquidity profile that those vehicles offer relative to the underlying assets?
Yeah, I think it's really important that you match assets and liabilities like with anything. So I think that in the private markets, probably credit is a better fit for higher interim liquidity. One, those do have terms for like direct lending, it's 5 to 7 years, but average hold is like 3 to 4 years. So there's going to be organic liquidity in terms of that turnover. Also, it's if it's in a registered fund wrapper, they've got to pay that income out as a distribution. But in retail land, a lot of people reinvest, so that helps with liquidity. So for something like private credit, where it has a stated maturity, it's producing income, I would be more comfortable with a wrapper like an interval fund where there's a minimum, say, of 5% per quarter for that asset category. Things on the equity side that don't have that, I think that maybe a tender offer where it's up to 5% are probably a better fit. And I think you can look at the turnover, and you mentioned private equity. So a lot of funds will invest, and those are longer term. So you can look at historically how much of the DPI or distribution to paid in comes back, and would that support even that up to amount? So I think historically for private equity, depending on the look back period, about 20-25% of NAV comes back in a year, but we haven't seen that in the last few years. So the question is, do you go with an average? Do you do like a worst case scenario? I think one of the things you want to avoid is that mismatch would be predicated on new flows coming in, because you kind of have a wrong way risk in a lot of environments where when people want out is when people will be less likely to be putting money in. So you're going to be more dependent on that organic liquidity in those tight times. And I think that's one of the things that you need to look at, because there's a proliferation of access points. Like to give you an example for infrastructure, not really like a retail product until recently, I've already come across 5 different access points within the category to where you've got to know the wrapper, how often does money come in, how does the money come out. So there's that layer of complexity at the access point level that I think institutional players don't have to worry about. But in retail land, it's definitely an important consideration about matching those two things.
Yeah. So just to kind of stay on the liquidity mismatch for a moment, because this is an important point, I think it's really helpful to really truly understand the risk that you're highlighting there.
Right.
And you gave the example that uh, if for some of the longer dated assets, private equity as an example, it may be the case that if you're in a fund that offers liquidity, that source of liquidity may not actually be an asset sale, but might be the case that you're trying to exit at the same time as someone else is trying to come in, so
Yeah,
you can sort of match those flows. And so, to your comment, uh, when is someone most likely wanting to exit? When times are tough and the market's down and you
right.
need liquidity, and that's when people aren't really entering into these funds, right? And
Right.
that's one of the biggest risks, is that when you want the liquidity, it's not there. Um,
Correct.
Now, are there other kind of aspects of that liquidity mismatch that kind of stand out to you from a risk standpoint, or is that the one that kind of maybe is the most obvious highlight?
I think what we do see is that a lot of these strategies that have s- periodic liquidity run a liquidity sleeve, and it can vary by size. And I think the concern there is, are you introducing public market beta in doing
Mhm.
that? Are you having a drag on returns? And so I would say that for certain asset categories, there are liquid or public versions that give you similar exposure, that it's still pretty close to pure play, but in others, it's just not. So I think that's the question of um, looking at that. Are they going to be forced sellers? Because I think the private markets has always prided itself on
Yeah.
deciding when to buy and when to sell. But when you introduce a perpetual vehicle, they might unfortunately be in a position to where they're balancing the needs of existing remaining shareholders and those that wish to exit. And so we have seen some funds need to sell in order to honor that 5%. And we want to make sure that they're doing that kind of in an orderly way and they're balancing their fiduciary responsibilities. I think 2 years ago, a lot of press was around real estate and dropping the gate is the phrase. I kind of don't like that. Oh, I think all but one in the NAV REIT space kept their terms. They didn't change them, and it took some time for that backlog to clear, but it did for the most part. So we just want to make sure that those are balanced um, because it is an important consideration for individual investors that it's not a forever allocation, but it is long term.
I think you just made a really great and important point too. Is it's imperative to know what you're getting into, and
Mm,
that to your point, like you may have an expectation that a private equity investment should yield a certain return. But then if because the fund manager is offering liquidity a certain way, the way they manage that liquidity is through a liquidity sweep, which may sound prudent and appropriate to avoid some of the other risks we talked about. But then as a result, the unintended consequences, one of the risks they're introducing now is that they're putting a different investment into the portfolio that has a
right.
different risk and return profile. And now suddenly you go from thinking you're going to get an X percent return to now you're going to get a X minus percent return potentially,
Correct.
or something different from X is maybe the better way to put it. And so it's imperative for advisors to really look at the structure of the underlying portfolio as well, and then think about the implications that that can have on other factors like the risk and return profile, not just the liquidity profile.
Yeah, I think that's important. I think the other thing is that as we see product innovation, I think one of the things to look at are potential conflicts of interest. I think historically the idea was that maybe retail investors got access to the B team or the leftover deals. We
Yeah.
really don't see that currently. Um, Part of it's through co-investment exemptive relief for registered products. There's rules of the road for that. But increasingly, what we're seeing is that institutional managers are providing access to their entire platform. We've seen news articles that limited partnership agreements now explicitly mention that these retail vehicles will get access to deal flow. So I think that's another thing that both LPs and those drawdown funds have to manage their expectations around that, but also retail investors about that potential conflict of interest. Because if you're co investing alongside those flagship funds, which do have the kind of 10 to 12-year life that you mentioned earlier, and it's time for them to exit, how do you do that when you're all in the deal together? And I think that that's something that, these funds are relatively younger, and we'll see how that plays out. Interestingly, on the private equity side, there's still kind of this overhang or backlog, whatever you want to call it. And so those exits, I think you would want governance in place around that and making sure that the structure that the manager has elected to use is consistent with treating each group of shareholders or unit holders equitably at the time of exit. Maybe we just need to worry about exits coming rather than how they're done, given the amount of backlog we have at certain aspects of PE and in real estate, apparently.
That's a great point. I'm really glad you brought that one up. And so, I think we've hit some of the really big questions and important points that sort of regularly come up in this space, especially from a client standpoint. Is I'm uncomfortable with alts maybe because of the liquidity profile, which we've talked about and explored some of the challenges and hurdles there. But there are solutions. There are solutions, and there are some appropriate strategies where the liquidity solutions are reasonable. And then you sort of brought up the challenge that sometimes is vocalized, which is that of am I getting the leftovers or what am I actually getting? And I think that's a really great point and one that we're seeing a lot of positive developments there that it's not the case. The other one that I think is a common refrain is fees. And
Mhm.
so I was hoping that maybe you could kind of, how do you have that conversation when it comes up of, oh, this is expensive or it's uncomfortable because of the fees that are associated with it. How do you navigate that and think about that when you're implementing that into your portfolio?
Well, I think fortunately, within the last 5 or 10 years, fees have come down. I think people are used to a 2 and 20. That's just not the case anymore, especially for these evergreen products. So that's helpful. But when I speak with advisors, I talk about the cost of active management. and what value are they adding through active management. And you pay more for certain things. And so it kind of varies by asset class, but I talk about the value that they add through actively managing things. So in private equity, at least for buyout, you're in a control position, right? So you have the ability to really influence how that business is run and grows and acquires things in ways that are not possible in the liquid public equity space. And for credit, I think like on direct lending, the ability to structure deals with appropriate covenants and having a majority or at least a blocking position for those instances where there is trouble, that you're in a position to strongly negotiate on a collaborative basis. So that's the way I have those conversations is that, look, the illiquidity premium is there at an asset level. It doesn't always pass through at a net return level, but what you're paying the manager to do is in ways either generate assets or structure investments that are not available to you in a, you know, in a liquid market. And hopefully the risk adjusted returns through that active management delivers you enhanced returns, but also helps manage downside risk. So that's the conversation. Like they're not doing this for free. No one thinks that private equity or private credit shops are charities. But the question is, can they deliver additional value net of fees? And I think with where the fees are now, best in class managers can do that pretty regularly, and there would be a persistence to kind of excess returns net of fees.
So I want to talk about one more thing that's a bit different for advisors or clients in terms of how the alternatives are implemented into a portfolio, and that is the alternatives. If you're going through the more traditional fund structure, are ones where it's a drawdown style fund, meaning you make a commitment and then the money is invested and called over time rather than all at once. And for folks who just have that 60-40-70-30 portfolio, they're not necessarily familiar with what that means or how that is implemented. So I was wondering if you could sort of spend a little bit of time speaking to, all right, I'm ready to do private equity. I've gotten comfortable with the liquidity. I'm using an investment vehicle where it says I'm committing X amount of capital to this investment, but I understand that it doesn't get all invested at once, and I have to have that be invested over 2, 3, 4, 5 years. How do you think about structuring that? How do you think about, well, what happens to the capital before it's, or what before it's been called in, and how do you kind of build that into the portfolio and the portfolio construction?
Yeah, I think that there are some advisors that are used to doing it, but those that don't, it's actually a really important conversation. And so what you've mentioned is going into kind of a capital call vehicle for the first time. And what institutions try to do is they have an entire kind of cash flow program to manage that J curve to where they're going to be optimally invested over time. For for kind of retail advisors, the step to go into a single drawdown fund, the first conversation I have with them is not about capital calls, is that you're going into a very concentrated, actively managed portfolio, probably of 10 to 20 names versus a larger index. So the question is, are they comfortable with that manager selection risk? Because when you have that much idiosyncratic risk in a single fund, private markets are already dispersed way more than public markets, but that is a choice that they have to be comfortable with. So we can get them there. Most retail clients do not have the capital to go into, even through feeders, a diversified program. So it's going to be an active bet. So we can guide them through it. It's very difficult, even with reduced minimums in a feeder into one of those drawdowns, to build a diversified portfolio. So what we also talk about is, where has product development been in the last 5 years? A lot of the perpetuals are meant to solve that very problem, to where the money goes in, you're fully invested in day one. Now, it might be a monthly sweep, but you're fully invested, to where you get that constant exposure and you don't have to manage it. And I think that that is the innovation that we're seeing for, wealth channel products. They get that. So they can make a few choices there. They can go with a single manager, get access to the whole platforms for private equity. That might be buyout, life science, and another vertical that they're good at, but you still have single manager, but you're getting a lot more deals and you'll get vintage diversification. So the traction we've seen in the wealth space is that, one, managing those capital calls and the money coming back is not really something that they are excited to do. I think they're willing to do it to get access to particular strategies. But I think more and more those evergreen vehicles, whether they're single manager or multi manager, are solving for that J curve problem. And I think the conversation you have to have after that is you're moving from money weighted returns, IRR multiples, into time weighted returns. And so those can be different. And so if you're expecting, high teens return, which is what's in every PE pitch book, how does that look when you go into a time weighted return where it's month to month and it might be a little bit different than what you were expecting?
Well, that's really helpful. And to follow on with what you were just talking about, you're talking about the idiosyncratic risks that are introduced when you're investing into a manager that might only have 10, 20, whatever investments in their underlying portfolio. And there are some solutions around that, but it is still at the end of the day, you're choosing to partner with a firm, even if they
Right.
have a more diversified portfolio. And so I was hoping you could spend a little bit of time talking about I guess we don't have enough time to go through the entirety of a due diligence process,
Right.
but maybe you could speak a little bit about what are some of the red flags, maybe, if you'll use the part, allow that term, that you look
Yeah.
for that might be unique within the world of alts. I know that advisors might be very comfortable with due diligence when it comes to traditional investments. What are some of the things in particular in the world of alternative investments that you really kind of look for to make sure that you're screening and filtering out to find the sort of the best partners for you?
Yeah, given the novelty of a lot of the funds that are available, you really have to underwrite at a platform level. And that means probably getting access to non public data. So when you're at a firm that has kind of an institutional approach to it, there'll be NDAs and other things where we can get access to a data room. But we even go beyond that. And so, like, to give you an example from private credit, one of the things that we'll ask for is what's called a loan tape. And we'll look at every loan that they've had, we'll slice and dice it to see if there's any kind of style drift in terms of the size of company that they're lending to, how much leverage there is, are spreads consistent, or are they really kind of market dependent? So I think that that level of diligence is difficult for an individual advisor to do. And at least in the US, there's usually a division between firm level diligence and then kind of client specific suitability. So I think that you want to be at a place that takes an institutional approach that does that work for you to kind of go through people, process, philosophy, and performance in ways that account for the idiosyncrasies of private markets. That's not always going to be readily available to you, even if it's a public product. So, having resources wherever you're doing your business to have those kind of one-on-one conversations about a qualitative approach to diligence because the managers will always put their best foot forward and you always have to take things with I'll just say a grain of salt about what that performance would translate to in a more retail oriented product.
One other question for you, again, that may come up, and I know that again, this is going to be very client specific, so we'll try to
Mm.
keep this to general terms. But um, an obvious question that we hear is around taxes, and
Mhm.
so have you uh, sort of encountered situations where taxes are a hurdle for alternative investments, or do you feel like there are solutions out there that can kind of handle any kind of tax situation that there might be from a concern from a client standpoint?
Yeah, I think one way I've broken things down is maybe do private markets and hedge funds, and the other one would be tax solutions. So a lot of the institutional products that have been around for decades are for tax exempt institutions. So they don't worry about, say, short term capital gains. It's not a big deal for them. However, for individuals in the wealth channel, it is a huge deal. So there are a number of products that are built around specific tax solutions. So concentrated stock positions that are highly appreciated, low basis. There are exchange funds. There's also 1031 and 721 programs for real estate. So those are critical conversations. But I think as well, the idea not only of asset allocation, but asset location can be really important. So you need to understand the nature of the assets you're investing in and the distribution. So for real estate, there can be a tax depreciation shield. And so some or all of those distributions might be return of capital. And you want to understand that so that you put it in the right sort of account, qualified or non qualified. But you also want to understand how much of that return of capital is driven by depreciation tax shield and how much of it is just a managed distribution rate that is meant to be competitive in the market. So you have to do some basic, but not necessarily immediately accessible math to understand how it's actually performing. Because you know, regulators are pretty clear that you should know the source of your distributions, and so that is something right alongside with tax that's really important. So, for private credit, that's typically taxable income. You probably want to put it in an account where it gets shielded from that, versus something that's kind of a longer term hold. It's going to be capital gains. Might be a better fit for a non qualified account. So, I think those conversations are evolving beyond what is the expected return to what's the composition of that return. Um, and also what's the tax character of it. Those are super important conversations for our clients.
That's really helpful and insightful. So we've covered quite a bit of ground around the way alternatives can be different from traditional investments in whether it be diligence, liquidity, et cetera, et cetera. Are there any other elements of the process that advisors really need to be mindful of when they're looking at alternatives and relative to what they would normally do from the world of traditional investments? Or do you feel like we've kind of hit the highlights?
I think as more business goes to the advisory side and to models based practices, alternatives provide great risk adjusted returns in a lot of instances, but they can be operationally difficult. So I think one of the things that you consider in introducing into a practice like that is, how does my firm handle this? What is the kind of the tech stack to work around it, and exclude positions from rebalancing, or how does that work? I think that that's the kind of the tall order that advisors face, is if they look to incorporate this into their practice on kind of a wider basis, they want efficiencies of doing that. And so your home office should be able to tell you how it works. And it's different at every place. There's a great heterogeneity in terms of how alts are done across the space. So there's not a one size fits all solution. But I think those are the conversations beyond investment diligence. How does my firm work? How can I incorporate this systematically and thoughtfully into my practice? Those are conversations that need to be had now. But to be honest, within the next few years, that conversation will probably change as more innovations, not in the product side, but on the platform side, catch up to speed in terms of the product development.
Awesome. So as we wrap up, I want to see, is there anything that we haven't talked about that you want to make sure that we touch on before we call it a day?
I would just say, you can get comfortable with alternatives and you think if it's a good fit in the portfolio. But one of the things is your client really needs to understand it, because one of the things we've run into is that there are times where there's an underperformer, liquidity dries up, and what will happen is it might be a small part of your book, but it'll take up a large part of your conversations proportionately. So we always work with advisors to really disclose the nature of the investment, so that even if there are unfortunate things that happen, they're not categorized as like out of the blue surprises, and that you can manage those. So I think that um, product development has increased the ease of use. I think they're more likely to be successful given lower fees, better liquidity. But these are not riskless. Even if they don't move a whole lot, you've got to understand the risk entailed by moving into the world of alts. And so not just you as an advisor, but your clients as well.
Well, Mark, what a great way to end. Thank you so much for all that insight and for us and for our uh, stakeholders here. I appreciate you taking the time and look forward to future conversations.
I do as well. Thank you for having me.